I think the gold price over the course of a decade will do well, but gold went too far too fast. I also think that people's reaction to the decline was naive. One needs to ask oneself, did the gold price fall by 7% or was it up by 100%? You'll recall that in 2023, the gold price was half of what it is today. I think that people have a myopic focus around time. In my experience, Kai, people who have problem with a 7% decline should find a different sector.
No.
I think that they have a decade of good markets in front of them. But I suspect that 2 or 3 times in the course of the next decade, that the gold price will fall by 25% or more without derailing the gold bull market. In that case, there's nothing wrong with gold. There's something wrong with the investor.
I almost feel bad asking more micro questions now, following up what might have led to the rebound in the price, because we got some more comments out of the Fed. One of the Fed governors will be stepping down, Bostic. He's from the Atlanta Fed. He was a hawk. So the market is maybe sniffing out more rate cuts. And since you're a credit guy, I know you're looking at that quite closely. What is your opinion on that? Had that any influence?
A rate cut will be catastrophic for America, wonderful for gold. A rate cut will signal, if it occurs, that U.S. society politically has lost any interest in defending the integrity of the U.S. dollar. I mean, we could talk about real interest rates, but that would be a long discussion. Suffice it to say that the U.S. economy doesn't need a rate cut, although the U.S. Fed may as a consequence of servicing the U.S. debt. But one of the things that has kept the U.S. dollar relatively strong compared to other fiat currencies has been that the nominal interest rate in the U.S. is higher relative to U.S. inflation than nominal interest rates are in other countries relative to their nominal inflation. A real policy of rate cutting by the Fed would signal to the world, as I say, that U.S. society doesn't care any longer about defending the integrity of the U.S. dollar. From a historical perspective, we saw this in 1975. At the beginning of that period, the U.S. tightened the interest rate, concerned about inflation. The gold price tanked, it fell by 50%. When the U.S. Fed lost its nerve at the end of 1975, the gold price went on a tear, an absolute tear. And I mean, as a gold holder, that's not unwelcome. But for the rest of one's life, that's a bad thing.
You just said something interesting. You threw the Fed and the Treasury sort of in the same sentence, the same bucket. Shouldn't they be independent from each other?
They should be, but that ignores the reality. The Fed is alleged to be independent, except that the executive appoints the head of the Fed. I am, as you know, Kai, I've just started a bank, and I have a lot of experience with the lower levels of the Fed. And the lower levels of the Fed, the employees that I've dealt with, believe that the Fed is the only agency of the U.S. government that is concerned with defending the integrity of the U.S. dollar. They believe that they're alone against Congress and the executive. The top of the Fed, who I don't know, I know a couple of ex-governors, but I don't know the current people, seem to be much more political.
No, it's the European market in general, and Germany, or German-speaking market. I throw Switzerland in there as well. Yes. Is very gold-focused, of course. Yes. Gold, silver, and copper to a degree as well. And I believe Europe has carried Canada, or the Canadian market, during the crisis in 2015, 2016, and even to a degree last year as well, when it was really bleak out there. Have you seen similar volume trends? Is that something you're observing? Because I know you're ranking portfolios, you have investors attend your conference.
I can go further than that. Yeah. Royal Bank of Canada, RBC, has identified West German retail as the second largest retail market in the world after the U.S. Yeah. So yes, I can give you an anecdotal description of it, but I don't need to do that. I have a statistic from one of the biggest players in the Canadian market. I also know that the higher quality Canadian financial groups, groups like the Lundin family, Ross Beatty, the Dundee people who I've known for a very long time, have placed a premium on communicating with the West German investor, which would suggest that what you say is true. Others, Keith Neumeyer, who you have today, I would suggest are reliant on the West German investor.
Yeah, he's been loyal to his shareholders out here. He's been coming up for 15 years minimum. So
Right.
he's pretty much written the book on marketing to European or German shareholders as well. Let's stay in Europe, though. Let's look at mining in Europe. Maybe let's draw a picture. Like, what is the landscape? What are you seeing? Is there anything of interest, and where should we be looking, perhaps?
If you include Russia, I'm extremely interested. I'm just not allowed. Russia has been extremely good to me in my life. 23 years that were very good, and then 1 year that was extraordinarily bad. If I'm ever allowed back, I'll go back with both feet. I would say for myself as an investor that the part of Europe that's most attractive to me in exploration is Finno-Scandia, because those countries still believe that mining is an important part of their economic development. The rest of Europe is harder. I would have a sense of humor for exploring the Iberian pyrite belt, but the permitting regime in Spain and Portugal, in terms of local opposition, is still very, very, very strong.
Isn't that separate north-south? Isn't that different wherever you are? Like regional?
Well, I think it is, to use very poor English, worse and worser. I had some success with Rio Narcea in the extreme northern part of the belt up in Asturias. That was 30 years ago, after the coal industry had declined, and there was local interest in jobs, but I wouldn't want to re-permit that mine today.
Fair enough.
I'm quite attracted to the Balkans as well. As you know, Kai, I was a founding shareholder of Reservoir Minerals, who made a wonderful discovery at Bor in Serbia. And while Serbia was a challenging jurisdiction, it wasn't a challenging jurisdiction because it was anti-mining. It was a challenging jurisdiction because they didn't have the regulatory capacity and capability. In fact, at Southern European Exploration, now EMX, we had a London law firm draw up a draft mining code for Serbia, and we gave it to the country as a gift because they didn't have one.
Yeah.
Now, they didn't keep it, but they kept big parts of it. So I'm attracted to Southeastern Europe as an exploration destination. I'm attracted geologically to the whole Carpathian Arch.
Right.
What we think of as classical Europe, France, Germany, I wouldn't want to be involved in exploration in that terrain.
No, absolutely. Let's talk about mining finance as well. Like, let's use that opportunity to talk about it a little bit as well. You've been really, really active. Although you've been telling me in a recent interview, it wasn't in New Orleans, but I think it was the one previously, that companies are starting to reject your money.
They reject my equity.
Yeah.
Let's face it, the juniors in particular prefer dumb money. The financings, well, first of all, the spate of financings that's happened recently suggests to me, when a company does a financing, they're telling you that your cash is worth more than their shares. They're accepting dilution in return for taking cash. Their argument, of course, is that with the fresh cash, they can make everybody's share worth more. But what they're suggesting is that the cash is worth more than their shares. If you have a circumstance where more people are issuing shares than buying them back, the managements as a whole are telling you that the market is at least fairly priced. When they say that they're undercapitalized, the terms in the financings suggest differently. There are no big discounts to market, and nobody's offering warrants. It was not uncommon in a real bear market, 1988, 1989, 1990, 1991. It was not uncommon to get a 5-year warrant in those markets. In today's markets, most of the managers can't spell warrant. The consequence of that is that I'm frozen out of most private placements because of the terms. The idea that I would subscribe to a private placement and receive restricted shares without a warrant doesn't seem smart to me.
What about life financings? Let's throw that in there. Is that an option for you?
Which?
Life financings? Those are the ones that come out with the 4-month hold. Only 10% of the market cap can be raised. There are limitations to it, but it's without the hold period at least.
Yeah,
Not even sure if you have access to it.
I mean, I have access. I have access to that in Canada, but I have access to that university in Australia.
Yeah.
In Australia, on a gold card placement, which is to say a placement with over $500,000 in subscription, I'm free trading from day one.
Perfect.
and that's not unattractive. But I do need to say that increasingly, when I see a company that I know is going to need money in the next 6 months, it used to be that I would go and offer them a financing with a warrant, and then they would go to a Canadian dealer and say, "Here's the bottom line. I have Rick here. Can you beat him?" Right. So what I'm more inclined to do now is support the stock before the financing, knowing that the company wants to trade the stock up, bid the stock up to get the financing done. When they announce the financing, I'll sell some portion of my stock into the financing and clip it. You have to be mature enough to take what the market is willing to give you. The market is likely unwilling to adapt themselves to what you're willing to do.
How far down the food chain do you have to go these days to find value?
I am going very far down the food chain now. As you know, Kai, about 5 weeks ago, I sold 25% of my junior positions. In retrospect, that was good timing. I didn't know it was good timing. I just knew that I had very large positions, and if you were going to sell them, you had to use a period of very high volume, and that was a period of very high volume. By selling those positions, I was able to eliminate all my risk. By selling about 25% of my junior positions, I was able to recoup all the capital I spent in the market since 2020, which means I sold 25% of my upside and I eliminated all of my downside.
Fantastic.
What I'm doing now is rebalancing within the sector. My competition is gravitating very much to development stage companies, which they think will be bought out when they achieve nameplate capacity. So that space is getting very crowded. What I'm now gravitating to is the prospect generators and the grassroots explorers that have a drill hole, the discovery plays. Because the discovery plays, in the last 20, 25 days, they've been mashed in the market. What were $60 million market caps are now 30 or 35 million market caps.
Any particular reason for that?
In risk-off markets, the tertiary assets, the riskiest assets, fall the most. It's something I've witnessed maybe 35 times before in the market, and I'm old enough to keep my eyes open to those lessons. You have to be extremely selective, but you also have to be extremely patient. One of the things I've learned, Kai, in grading now almost 100,000 portfolios for investors, is that most investors own too many stocks. They don't know the stocks that they own well enough. And many investors get the strategy right, but they get the tactics wrong. I looked very carefully at every stock that I'd made 1,000% on or more in my career. I did this study about 7 years ago. But I learned some very interesting things by doing that. I learned that the average 10-bagger took me 5 or 6 years to achieve. It didn't occur in 3 months. And the average 10-bagger, at least once during the point in time I held it, exposed me to a 50% or greater share price decline. Where I really made money is where I had enough courage in my convictions that when the stock fell by 50%, rather than selling it, I bought a lot more. And so I think that investors need to own fewer stocks. They need to have an opinion as to value and future value, rather than focus slavishly on price. And then they need the courage of their conviction. They need persistence and tenacity. And I see that missing in many retail portfolios.